Topic: Modeling Overview and Interest Rate Models. Examines the role of financial models in investment analysis, portfolio management, and fixed income valuation. Financial models are simplified representations of complex market relationships designed to assist investors in forecasting returns, evaluating risks, and pricing securities. The topic emphasizes that models are essential tools for investment decision-making, particularly within fixed income markets, where interest rates strongly influence asset valuations and portfolio performance. Investment professionals use models to estimate future cash flows, evaluate economic scenarios, and assess the sensitivity of investments to changing market conditions. The topic focuses specifically on interest rate models, including equilibrium models, arbitrage-free models, the Black-Dermontoy model, and the distinction between P-measures and Q-measures in financial modeling. Investment strategy models are designed to help investors analyze financial markets systematically and support disciplined decision-making. The topic distinguishes between theoretical, empirical, normative, and positive models. Theoretical models are based on economic assumptions and mathematical relationships, while empirical models rely on observed market data and statistical analysis. Normative models prescribe how investors should behave, whereas positive models attempt to explain actual market behavior. Effective investment models allow investors to evaluate expected returns, volatility, correlations, and risk exposures under different economic conditions. However, models are inherently imperfect because financial markets are influenced by uncertainty, behavioral factors, and evolving economic relationships. The topic stresses that models should be viewed as analytical tools that support judgment rather than precise predictors of future outcomes. Equilibrium fixed income models are one of the major categories of interest rate models discussed in the topic. These models attempt to explain how interest rates evolve over time based on underlying economic assumptions and market equilibrium conditions. Equilibrium models assume that interest rates follow specific stochastic processes influenced by economic variables, such as inflation, monetary policy, and investor expectations. Examples include the Vosicek model and the Cox-Ingersoll-Ross model. These models help investors evaluate bond pricing, yield curves, and interest rate risk. Equilibrium models are useful for understanding the general behavior of interest rates and generating long-term scenarios. However, they may not always fit current market prices accurately because they prioritize theoretical consistency over precise calibration to observed market conditions. The topic also examines arbitrage-free models of the term structure, which are designed to ensure consistency with current market prices and prevent riskless profit opportunities. Unlike equilibrium models, arbitrage-free models focus on accurately fitting the existing yield curve and pricing fixed income securities consistently across maturities. These models are widely used for valuing bonds, derivatives, mortgage-backed securities, and interest rate options. Arbitrage-free frameworks incorporate market-observed data and adjust model parameters to match current pricing conditions. By eliminating arbitrage opportunities, these models provide more realistic pricing relationships within fixed income markets. The topic highlights that arbitrage-free models are especially useful for practical trading, risk management, and derivative pricing applications where accurate market calibration is essential. A key model discussed in the topic is the Black-Dermontoy BDT model, which is a one-factor arbitrage-free interest rate model widely used in fixed income analysis. The BDT model assumes that short-term interest rates evolve according to a binomial tree structure and are log-normally distributed. The model calibrates itself to the current term structure of interest rates and observed market volatility, making it effective for pricing interest rate derivatives and evaluating bond portfolios. The BDT framework allows investors to analyze interest rate movements under multiple future scenarios while maintaining consistency with current market conditions. Because of its flexibility and practical application, the BDT model became an important development in fixed income modeling and interest rate derivative valuation. Finally, the topic explains the distinction between P measures and Q measures, which are fundamental concepts in financial modeling and derivative pricing. The P measure, or physical probability measure, reflects real-world probabilities and is commonly used for forecasting economic outcomes and estimating expected returns. In contrast, the Q measure, or risk-neutral probability measure, is used primarily for pricing derivatives and assumes investors are indifferent to risk when valuing future cash flows. Under the Q measure, expected returns are adjusted to reflect risk-free rates rather than actual market expectations. Understanding the difference between these measures is essential because financial models may produce different results depending on whether they are used for forecasting or pricing purposes. The topic concludes that effective modeling requires both technical expertise and careful interpretation of assumptions and limitations.